I remember last year, end of March, and the price was close to $4,500 per ton. So now we are close to $9,000 per ton, and we are living in completely different market environment. For the last year, we saw strong rally, and I think it was partly due to investments demand, and many people on the market first at their life, they started to consider copper to be financial asset. And that's why you can see the performance of the metal since the beginning of this year. And for sure, it's much better than many equity indexes or fixed income investments or even, for example, other types of high risk investment products. Fundamentally, if we are analyzing supply-demand balances in different parts of the world, for sure, China was driving demand up, and Latin America was struggling with supply last year. But fundamentally, we can say that the market provides some support to current high prices of 9,000 K per ton. The largest part of the mine supply is from emerging markets, and including Latin America. And we know that there is indirect link between rate of strikes and copper price. So if you have copper price around 9,000 per ton, you can expect that workers may ask for more money, and unions may address new questions to the shareholders and to employees. So supply disruption may be in 2021 on the level like 5% as usual, and probably if we are considering situation in Chile, the political environment is not as stable as it could be, and elections in autumn of this year may also affect the activity of the state-owned companies, including producers of copper. And for sure, emerging markets, they were very much negatively affected from COVID. And to overcome the crisis, recently in Chile, for example, there were discussion on additional royalty. In Russia, we have additional taxes for the mining company as well. So tax burden for the copper producers may be much higher. And if we assume inflation of costs, then it's also supportive for the copper prices from my point of view.
On the one hand, moving up at about 13% compounded over the last decade or so is copper concentrate imports, so staggering growth in the amount of copper concentrates coming into the country, obviously to meet the requirements of that additional smelting capacity. But on the other hand, policy-driven changes to scrap have resulted in a movement in the opposite direction. So a move to progressively prevent lower grade scrap from coming into the country and effectively outsourcing that to countries in Southeast Asia resulted in higher grade scrap coming into the country, but at lower volumes. So this is quite an important development, but certainly on the copper concentrate side, so from the mine supply side, that's been seeing tremendous growth. I think what's quite interesting here is actually just coupling in the price movement and looking at this. And of course, negative correlation does not mean causation, and I'm not suggesting it does here either, but it is quite interesting to see from the bottom of the market, sort of March, April 2020, where TCRCs were high, and you started to see the protracted supply disruptions coming out of the market, so Peru, Latin America, etc. And you saw that the tightening of the conch market, and that was in essence to some folk a bullish marker for the copper market, because it's potentially a sign of tightening on the upstream side of the raw material value chain, which can then flow through ultimately to the refined side down the value chain. So that was quite interesting, and you've seen that trend continue with spot TCRCs plummeting of recent, while copper prices have surged very, very strongly. This is showing you some of the imports of copper concentrates into Malaysia and Taiwan, And these are known areas where there's a fair amount of blending capacity. In particular, some of the strategies in these two countries are to blend out high arsenic material, or more recently blending out some parcels of high fluorine material. An example of Indonesia in Taiwan imports there, and or blending out various complex material, blending in certain precious metal concentrates. So there's a few strategies employed here in Southeast Asia. But the main point here is with a large increase in blending capacity in the Chinese market could begin to extend their sourcing capabilities, which would start to potentially divert concentrate flows in this part of the world. Looking at the fundamentals, certainly from the expectations, it looks quite positive in terms of the concentrate market and the refined market. So looking at potential deficits again for this year, whereas last year was effectively, according to CRU, relatively balanced. So I mean, summing that all up in terms of the heat zone for copper right now, I would just say you've really got the low TC/RC environment. You've got the potential for supply disruptions again, and speed of vaccine rollout in some of the emerging economies certainly that are supplying a lot of this product. And then you've got the robust demand out of China expected again, and you've got the rebounding demand expected in the rest of the world. So it seems to me a fairly bullish backdrop for copper.
If you look at the copper semi-fabricated product demand, which are the products which will the fabricators produce, and for example, wire rod, which goes into wires, tubes, or plates, sheets, and strips. If you look at the demand, and this is an indexed semis demand, you see that in China, the semis demand is much more erratic, and with again dramatic drop, but immediately recovery and a growth rate in the semis demand. While in the US, the semis demand was not dramatically impacted, but it was a decline throughout 2019 and 2020, and recovery only expected in 2021. This is very important to see that China is around 5 times, the Chinese copper market is about 5 times of the size of the US copper market, and it is much more important for the global market what happens in China as opposed to the US. COVID has impacted different end-use markets within the copper market differently. The utility market, and of course the utilities have long-term investment in electrifications and the expansion of the network, and these long-term investments were not necessarily impacted by COVID. So there was a more stable demand for utility power cables, winding wires in transformers, and bus bars. The economic growth is expected to be slower in 2021, and the 14th five-year plan, which starts this year, is specifically aims at moderate GDP growth with focus on domestic markets. On the other hand, the government, the Chinese party and the government has committed to carbon neutrality by 2060. And by China being currently the world's largest carbon emitter, this is a very strong commitment for the government to move electricity generation from the traditional to the renewable sources. And we will definitely expect to see more demand in the future for renewable power cables, for winding wires in transformers. But we also expect certain substitution by aluminium, especially because the cost pressure of renewable energy projects and the capex is very high. We expect an accelerated growth in 2021, and it's partially the rebound from COVID-19, but partially an organic growth. The carbon footprint, the renewable energy, the Biden administration has is committed to rejoin the Paris Agreement, and we definitely see a positive direction.